During the last 2 years, we've experienced one of the most complicated real estate markets in recent history. COVID was a huge driver, one shutting down our economy for weeks and months at a time. Homes became our offices, our schools, our gyms. Dining out became obsolete and was replaced by Uber Eats and DoorDash. Companies like Amazon, Netflix, and Zoom saw record profits and expansion as lockdowns became reality. Record money printing and pent-up demand has led to one of the highest inflationary periods of our time. Real estate saw the largest year-over-year returns, beating out the S&P for 2 consecutive years. Sellers named a price, and the home was sold in days, hours, and even minutes at a time. Now, we're at a time of a great reset. Hello, everyone. My name is Hector, and I'm the broker owner of Weichert Realtors Exclusive Property. I've been a top producing agent for many years. My background is in finance, and I specialize in data analytics as it pertains to real estate, and I'm here to provide you with important information regarding real estate in the Tampa Bay area. Okay, so first I want to start off with this data. This data is going to be very important in predicting recessions, and that's the direction that we're heading into now. But this is when the 2-year Treasury rate exceeds the 10-year Treasury. Let me put this into perspective. So you go to a bank and you get a CD for 6 months. The CD for 6 months, let's say it's 1% that it pays you. And then you get a CD for 5 years, and that CD for 5 years pays you 5% because you're holding the money in the bank long term. So obviously when the money is in the bank long term, you actually make more money because it's the time value of money. So the longer the term, the more you're expected your return to be. Well, the inverted yield curve basically says, well, instead of your 10-year or your 5-year CD paying 5%, that's going to pay 1%, and your 6-month CD is going to pay 5%. So there is this sudden rush to these short-term certificates because there's a lot of uncertainty in terms of what's going to happen in the future. So that just gives you a little bit of background in terms of how this works. So during the dot-com era, back in the late 90s and early 2000s, we got this inverted yield curve. This signified a recession, which happened. And then we all know about the housing market bubble that happened here in the 07-08 timeframe. So again, you had another inversion. Well, in 2018, 2019, we started trending downward, and we slightly inverted ever so briefly. But guess what just happened now? So it originally happened on April 1st, and now it just happened. It has continued to stay inverted now for over a week. So what this typically does, it's a leading indicator indicating that we are potentially going to head into a future recession. And we know that the first quarter of 2022, we actually had confirmed negative GDP growth for the first time since 2018, so somewhere around here. And now the expectation is that we will have negative GDP growth for 2022, quarter 2, which would mean we have 2 consecutive quarters of negative GDP growth. Well, why does this all make sense? Well, I'm going to explain. So if we look at the historical data in terms of real estate inventories, you'll notice that in January, and we only have data through June this year, but in January, the inventory is typically higher than in June because you've got your peak real estate season and you've got your absorption, your maximum absorption. So typically, you'll have more inventory. There's one exception, and that's because that was leading to the 2019 situation. We had interest rate increases, very similar to what we're experiencing now, and we had a very ever so slightly recession. So then you've got, so 2019, you've got, again, more inventory in January than you do in June because your absorption is greater than your incoming supply. And then, of course, we went through this period, this COVID period, where we had this hard push to the downside in terms of inventory because the absorption rate was so great. So here in January, we've got 13,779 active listings. Then by June, we had 10,800. Same thing here in 2021. We were already spread very, very thin here. And then you've got 5,800 here, so about 1,000 less homes, even though you have new supplies continuing to enter the market. Well, welcome to 2022, where we had the lowest inventory levels initially, and we have now almost doubled. So this would be about 9,200 would be doubled. We'll probably expect to see that in July. But if you look at inventory levels for the end of June compared to the end of January, you can see that we went from 4,600 to 8,700. Now, these statistics are in fact staggering. Now, if we look at the CPI data that just came in, we were at a hot 9.1%. And you can see that clearly right here. This is the US Bureau of Labor Statistics. So this is not information that we're making up. These are all facts, verifiable. This is the highest reading since 1981. So we're talking about 41 years. If we understand how we combat inflation, it's interest rate hikes, right? So that's the one key way that you would combat inflation. And what's happened is we went from a 3% interest rate to a 6% interest rate, or roughly thereabouts, in a period of 5 months. So that has completely shocked our market. So number one, it's driven inventory levels. So again, we go back to this chart, we were nearly double the amount of inventory that we had in January, based on month end of June. Now, what happens is, and this, again, we're not making this up, for every 1% increase in interest rates, a buyer's buying power decreases by 10%. This means someone who was qualified back in December or January to buy a $300,000 house can now buy a house for $210,000. Now, imagine the amount of pricing pressure that places on the market. So you've got skyrocketing inventories. So again, we're looking at double the rate from January. You've got price reductions, at a high that I haven't seen in many, many years. And then you've got cancellations. So if we look at, and some of these may not necessarily be cancellations, it might be folks who are just no longer able to purchase. So this was recently published by Bloomberg, and it indicates that 60,000 contracts fell through in June. This is 15% of all home purchases in June were actually canceled. So when you look at the numbers, and again, if someone qualified for a $500,000 house and now we're 3% higher, 3% equals 30% reduction in purchasing power, that means that someone who was qualified for a $500,000 house could only buy a house for $350,000 in today's market. So something's got to give. Either prices have to come down, or we need more inventory at those lower levels, which anytime that there is something at those lower levels, someone else buys it up. So that's that's a tough call there. So when we look at the amount of price reductions, because you've got consumer or seller expectation has been that, hey, I'm just going to price my house at X, and I'm going to expect even more than that. So we had that happen for 2 years, but guess what? Those days are over. You've got inventory levels that are rising, and as a result of that pressure in inventory, and the downward pressure on prices as a result of the higher interest rates, then you've got price reductions. So this is 2021. Look at the amount of price reductions. Typically, you'll peak out over here, which is right around the time that school starts. 2020, 2019. So typically these lines are very, very stable in terms of price reduction. But now you look at 2022 and we're about 2.5 times higher than we were in 2021, well above the norm. That's a 250% increase in price reductions. Again, something that we haven't experienced, but I think it's important for the public to know. So when you're out there pricing your home, I'm not saying give your home away, but when you're pricing your home, you have to price it at a price that someone can find some sort of value to acquire the property. Or otherwise, it's going to be another one of these statistics. And guess what happens? As soon as your home is listed, you're going to be on the first page of every single website that's syndicated on. As time goes by, you're going to be pushed to pages 2, pages 3, pages 4, 5, until you're all the way in the back, and people never scroll that long or that far into it. unless they look at a map view, which is always an option. But most of the time, people are going to want to know, okay, what's fresh in the market? I've already looked at all the inventory that was out here, so I want to know what's fresh today. So this is what's really impacting the market. I wanted to share this information because I think that there could be some value here. If you do have any questions, feel free to reach out. I get questions every day from our clients. And, again, this is just an opportunity to help educate. Some of you may already know, but at least, this could either provide you with confirmation to what some of your beliefs are, or if you're still at the belief that, hey, houses can be priced at any price and someone's going to buy it. That's not the case. I hate to be the bearer of bad news, but I have to be a realist. And in this situation, that is definitely not the case. So any questions, feel free to leave a comment below. If you like this video, like and subscribe if you want more information, and it will just keep me motivated to provide you with more and more of these educational tools to help you make informed decisions. Until next time, have a great night, guys. Thank you.